Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. We've just released our India Market Outlook for 2025 titled Bridging the Gap. My name is Ravi. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be your host for this podcast. 2024 was indeed an eventful year. A record number of nations went into elections, including India and the US. Financial markets weathered surprise polling outcomes, escalating geopolitical tensions, and a resurgence in inflation, triggering a flip-flop of monetary policy actions. But overall, it's been a strong year for markets. For India in particular, this was a year of two halves. First half seeing strong performance of Indian equities and bonds as strong economic growth and corporate earnings delivery supported performance. However, second half saw an increase in market volatility, with markets giving up a part of the year-to-date gains. Nevertheless, Indian equities look to end the year 2024 with positive returns for the ninth consecutive year, making it the longest streak on record. Indian bonds are also on track for the best year since calendar year 2020. Now, to get a sense of what to expect from the markets in 2025, we have with us a special guest today, Mr. Vinay Joseph, who heads the investment products and strategy at Standard Chartered Bank India. Hi Vinay, welcome to the podcast.
Hi Ravi, thanks for inviting me.
Now, to get started, could you give us a sense of how the macroeconomic outlook for 2025 stands?
Before going into 2025, it's important to realize what happened in 2024 late. We saw a pullback in equities, and this was driven by a cyclical slowdown in economic growth and earnings, albeit from a high base but also tighter financial conditions, given higher than normal interest rates, as the RBI stayed focused on limiting credit stress and containing inflationary pressures. This drove record outflows from Indian equities. Now, as we step into 2025, we expect economic growth to trend higher. There are three supporting factors. First, we see domestic demand recovering. Second, we are likely to see a pickup in government spending. And third, an improvement in private consumption on improving prospects for rural incomes as key supports. Further, the strong performance of the incumbent NDA alliance in the recent key state elections bodes well for policy continuity, and this should support private investment cycle revival, which has been a bit lackluster this year.
Well, since you mentioned growth and its linkage to election outcomes, how do you see the recent change in US political setup impacting the markets? We've already seen the US Fed lowering its interest rate forecast for 2025. Could it also influence the RBI?
So coming to US elections, clearly the outcome is the cornerstone for 2025, with the Republicans controlling the House and the Senate, and obviously the uncertainty around US President Trump's proposed policies, especially increased tariffs. This is a key headwind on the macro side for emerging markets, including India. Now, an intense trade war is likely to be negative for countries with major trade surpluses with US. This is where we expect India relatively to be a less insulated, given a large domestic focused economy and Indian exports forming a much lower share of overall US imports at about just 3%. While US Fed has delayed its rate cut expectations, it's on the back of strong growth and higher inflation in the coming few months and improving employment outlook. So these may not be very negative factors for the markets, especially risk assets. Now, coming to RBI policy, our base case is RBI will start commencing rate cuts in Q1 2025. However, this easing cycle is expected to be a shallow one, with the possibility of around 50 to 75 bips of rate cuts. The RBI is likely to be wary of potential external sector headwinds as growth recovers from a cyclical low. We do expect headline inflation to trend lower in 2025 versus 2024, given an improved outlook for food prices, still modest core inflationary pressures, and likely government active interventions in case of supply-side shocks. But this will still be above RBI's medium-term target of 4%.
Now that we have the macro outlook, what does it mean for investors and their portfolios, given that investors have failed to hold on to gains in Q4 of 2024?
So we like our acronyms. So in our view, we believe investors can bridge the gap in the portfolio performance through First, which G stands for gearing up by increasing risk in their foundation allocations. We believe the above macro backdrop, which I just alluded, is very positive for risk assets, and we raise equities to overweight in our foundation allocations. Now, this is supported by a view of improving growth, higher government spending, and the commencement of RBI's policy easing cycle. All this bodes together well for a pickup in corporate earnings. Now, concerns are there on elevated valuations, and are we likely to see a multiple expansion? We believe earnings growth would be the driver of returns, supporting the likely outperformance of equities compared to cash and bonds. Domestic equities, especially in India, is also supported by other profitability measures. When we compare on return on equity, we remain much ahead than major peers. Maybe only US is close to us, and that justifies why both these two markets are trading at higher valuations. Lastly, foreign investor positioning in domestic equities still remains close to decadal lows. Now, within equities, we are overweight large cap equities given a greater margin of safety in terms of both earnings and valuations as we go ahead into 2025. Now, the second part of gap strategy is A, which is adding hedges to limit downsides. We know there's an environment of several known risks, and this means there's an importance to add portfolio hedges. We see gold as a solid core holding and a key portfolio diversifier. Central bank demand is likely to remain a key driver for gold prices. In addition, you have support from safe haven demand, escalating geopolitical tensions, and any inflationary worries of falling bond yields, which adds as positive tailwinds for gold. On the contrary, also you have alternate investments and multi-asset strategies that have lower correlation to the two major asset classes, fixed income and equities, and these are potential routes to improve your diversification and lower portfolio risk. Lastly, of our gap strategy, P means preserving the yield. Now, bonds is a core holding for us, which means we are neutral on the asset class. We like, however, bonds and are overweight cash given relative absolute yield on offer. We expect bond yields to decline over the next 12 months. Given an elevated inflation scenario amid a cyclical growth recovery, this yield fall is still going to be shallow, as we highlighted earlier, because of shallow rate cuts. Overall, we expect bonds to outperform cash because the yield on offer is much higher. Within bonds, we like the medium and long maturity bonds. The higher carry yields on offer provide adequate compensation for clients or investors to extend their maturity in fixed income allocations, as there is a potential of price gains as yields decline over the near term in the next 3 to 6 months.
Well, so far we've discussed most of the positives, and as has been the case over the last 4 years, there's something in the year that surprises investors. Now, what could cause us to change our view?
Well, that's an important question. We are at the cusp of pivotal events that risk changing the economic, geopolitical, and financial market narrative. Now, in the US, we know President Trump is set to take office in January, and following which we are likely to get greater clarity on his policy agenda, but that will come with volatility. In China, policymakers are likely to provide further policy support measures which have the potential to revive growth. Finally, stronger US growth raises the risk of inflation, and we saw that at the recent US Fed policy meet, limiting Fed's headroom to continue cutting rates. These above factors can have a varying impact on India's growth, FX, and foreign portfolio flows through direct or indirect channels. Now, coming back home, we expect that the Indian government will provide some policy support to reset the weakening consumption which we have seen since the start of Q2 this year, given the strong political mandate they have received in the key state elections. The lack of any policy support measures could dampen risk sentiment and economic growth, as well as the strong earnings outlook that Indian equities have, which is still recovering from a low base.
Well, this brings us to the end of this episode. Thanks, Vinay, for the detailed insight and taking the time out to explain our macroeconomic outlook for 2025 and how investors should position their investments to navigate the near-term uncertainty.
Thanks, Ravi, for having me here.
Thanks, everyone, for listening on. Do reach out to your relationship manager for a copy of our India Market Outlook 2025. You can also find it on our website at the SC Standard Chartered Market View on the go or the SC Invest section at www.sc.com/in. Have a great day.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.